A very good afternoon to all friends. I'm Sanjeev Singhal, Central Council member and Chairman Auditing and Assurance Standard Board. I welcome you all to this 136th program of AASB for this council year. So far, 86,000 plus members have attended these programs on auditing and assurance. We have covered various topics. Today, we are covering another important topic, which is key consideration in the audit of healthcare sector. And to take this topic, we have a very young and very learned professional, CA Lavnish Agrawal, who is a manager with assurance team of the Pyrian. He has vast experience in the statutory audit and in the large accounting firms. He has been managing US, Texas, or Houston region independently, and he has taken many sessions for the Institute of Chartered Accountant of India. We welcome you, Lavnish, and we request you to kindly deliberate on the topic. Thank you.
Thank you, Sanjeev sir, Anil sir, and the whole ICI committee for offering me a chance to again take up the session over here. So for today's session, our topic would be key considerations on the healthcare sector. Let me quickly present the screen. So today's topic is key consideration in audit of the healthcare sector. So we will be covering a couple of topics over here. The major ones are, first of all, just to give a background, we will be covering the healthcare sector's growth in the current market in India. Secondly, we'll be covering about the risks which are associated over there. Third, we'll be covering about the audit approach that we need to perform. And fourth, we'll be covering about the key considerations or risks or probably the reporting requirements which are out there and are required for the healthcare sector in India. So healthcare sector in India, if I talk about, is basically classified into two categories. One is public and the other is private. And it is one of the largest sector in India, both in terms of revenue and employment. So even if I talk about from the perspective of large metropolitan cities, tier 2 cities, or even if it's a small village,
Lavnish sir, you are using PPT right now, or you will use after some time?
So is it not visible?
No, it's not visible.
Just let me.
That's why, sorry to interrupt you.
No worries. Is it visible now?
Yes. Make it full screen. Now make it full screen, sir.
Yeah.
Okay. Now it is fine. Now you please start, sir. Kindly.
Yeah. So again, just to reiterate, we'll be covering a couple of topics over here in terms of healthcare sector, majorly focusing on the audit side. So first of all, we'll be talking about the dynamics of the healthcare sector, how it is captured in the Indian economy, how it is covering, how it is developing, what the government measures, and probably in terms of auditor, what are the risks associated with it, and what audit approach should we follow in general, and the key considerations are probably how auditor has to report in the financial statement. So in terms of the healthcare sector in India, it is majorly divided into two parts. Basically, one is the public and the other is private. Public is basically the government hospitals, and private are usually the private hospitals, be it Medanta, Fortis, AIIMS, and all. So AIIMS again being in the public. It is one of the largest Indian sector, both in terms of revenue and employment. So be it tier 1 cities, tier 2 cities, or probably villages, everywhere there is a health hospital, right? So it covers majority of the regions in India and provides employment. Market size, if I talk about the market size, it is expected to reach $132 billion by 2023 compared to $61.8 billion in 2017, which is approximate 16 to 70% growth year on year. In economic survey of 2022, there is a good amount of expenditure that has been incurred, both in terms of public sector, which is approx 2.1% of the GDP. So if you see that government sector or probably the healthcare, specifically healthcare sector, and that too on the public side, contributes a lot of amount in terms of the healthcare side. The Indian medical tourism size is also estimated to be 6.79 billion in 2023 and is expected to reach around 12.64 billion in 2028. Even digitally, these days, digital side is also moving, where majority of the healthcare services are provided on mobile apps, right? So the expansion is already over there, and the sector is growing rapidly. Some of the major initiatives taken by the government of India in the Union Budget of 2024 is INR approx 89,000 crores was allocated by the Ministry of Health and Family Welfare, which is almost equivalent to 3.4% increase compared to last year, where it spent 86,000 crores in 2022. So this clearly shows the focus of the government in terms of the healthcare sector in developing the hospitals in each and every city. Then the another project by the government of India is Ayushman Bharat Pradhan Mantri Jan Yojana, where almost 7,200 crores has been spent, allocated, sorry, and 12, which is an increase of 12% from 2022, which is approximately 6,412 crore. INR 4,000 crore was allocated under the medical treatment of CGHS pensioners. Approx 3,000 crores had been allocated via National AIDS and STD control program. National Health Mission has also been allocated 29,000 under the centrally sponsored components, and approx 6,000 crores have been allocated for the establishment of 22 new aims uh, in the current year. Now, we will talk about a couple of common malpractices which we usually see in the healthcare sector. So, what are the issues that, as an auditor, or probably in a routine life, what people face, and as an auditor, we should focus upon? First of all, is overbilling to patients. This is a very common practice that and has media exposure as well. So, when we talk about overbillings, there's a usual tendency of hospitals prescribing tests, medicines, and other procedures, maybe a laboratory test, through which they charge from the customers or probably the patients. So usually, we see that hospitals and practitioners do not permit the reports from outside. They prescribe the reports that is usually from their hospital. So that is one of the malpractices being followed. The second is government healthcare schemes, where fake patients and treatments to claim benefits under the various schemes are seen. So, what happens is, in smaller hospitals, which are in the remote areas, they usually take the IDs, they procure the IDs of the original patients and basis that claim subsidies and funds from the healthcare schemes. The third one is arrangement with the doctors and other consultants, where the fee paid to doctors is directly related to the revenue generated by them. We usually observe that doctors prescribe medicines of a particular brand, or they usually recommend a particular hospital where they are getting referral fee from the hospitals. So referral fee again is again directly linked to the arrangement with doctors. Fourth is unaccounted cash receipts from patients. So usually the receipts for hospitals are majorly on two accounts. One is cash, and the second is credit cards. So there is a common tendency or usual practice where cash taken from patients are usually not fully accounted in the books of accounts and are most and could be transferred to the the promoters directly in the personal accounts. The next one is discount shown in books to reduce cash collection in books. What happens is, so the billing usually in case of hospitals is recorded at a gross charge amount, and then the hospitals, what they do is they manipulate the invoices in terms of putting in a large amount of discounts to decrease the billing, and basically they manipulate the cash. The next is misutilization of legacies and grants received. So what happens is, usually hospitals receive grants and land and other facilities from government at a very concessional rate. This is usually done in the form of trust, where trust utilize all these benefits received for the private players, and they through various agreements they pass on these benefits to the private players. The next is referral business, both from domestic patients and foreign patients, against Medical Council of India. So as said, hospitals are referred by the practitioners, so they get reimbursements, gifts, and other kind of benefits from the hospitals. So all these practitioners this is usually not allowed under the Medical Council of India, receiving gifts by the practitioners from the hospitals. But again, these kind of policies are still in practice as a business requirement. So usually hospitals do that to inflate their business. The next is fraud billings to increase the TPA claims. Again, this is one of the frequently observed issue where billings are inflated to get the increased TPA claims. So what happens is, in hospitals manipulate the billings. Let's say, for example, there were uh, two stunts utilized for a patient, but they might increase it to three stunts, and that's how they charge more from the TPA service providers, or they might put in a couple of tests that were not even conducted. So this is another area where report of frauds have been observed, or problem inconsistencies have been observed. The next is structural issues. Trust model is created to use concessions from government and then private hospitals, example, concessional land, equipment, or other support. Again captured. So usually the lands provided to hospitals, or probably this places provided, the property, the equipments provided, all these at our concessional rates. So these are provided to private players in terms of through various agreements to benefit them rather than for the general public at large. The next is inappropriate bills to cover cost of money used elsewhere. Fake advertisement bills, consultation bills, other bills. Next is pharmacy, in-house or outsource, high margins versus low margins. So usually we see that there are two kind of medicines. One are generic medicines, the other are high margin medicines of the private players. So there is a usual tendency to recommend the medicines of a private players and rather than of the generic nature, where hospitals tends to charge huge margin from the patients. So now we'll be talking about how healthcare frauds are conducted, how many kinds of healthcare frauds are, which one are identifiable, or which affects the audit and which are very difficult to find out. So what exactly is healthcare fraud? Healthcare fraud is a matter involving the violation of trust between healthcare providers, managers, and patient using deception to gain an illegal financial advantage at the cost of the patient. The various elements include deception, misrepresentation of the truth to lie, hide, or manipulate the truth. So, what is a healthcare abuse? So, healthcare abuse, first of all, is in a nature where it is very difficult to identify as an auditor. So, it includes incidents or practices which sway away from actual medical procedure and are different from sound medical practices. So, for taking an example of such a procedure, when we talk about, let's say, doctor prescribing a particular test to a patient, so it's very difficult to identify whether the test was actually required or not, since we are not technically, as an auditor, we are not technically that expert in terms of understanding whether a particular surgery was even required or not. So this is a kind of healthcare abuse which is very difficult to identify as an auditor. But when we talk about healthcare fraud, this is something we can reduce or identify through our audit procedures. So what is an healthcare fraud? And healthcare fraud is an intentional misrepresentation or deception of service which are known to an individual or organization to be false and involves unauthorized issuing of reimbursements to a medical organization. Couple of examples we read in the earlier slides where we saw that through manipulation of invoices, transfer of benefits received from the government, inflating the invoices of the TPAs, and all these come under the medical fraud, healthcare fraud. So, what are the common instances of medical fraud? First is upcoding, billing a more expensive service procedure than that provided to the patient. So, upcoding is a very usual practice followed in the hospitals or probably the healthcare sector, where we see that usually a more expensive procedure is recommended to the patient, suggesting benefits. Ideally, we see that there might be three kind of surgeries which might give similar kind of benefit to the patient, but the hospital through various techniques provide incentivize the patient to take a different one. That is what upcoding is. Second is insurance claim, performing necessary procedures or providing unwanted services solely for claiming insurance. So there are a couple of tests which are recommended by the doctors, which are not even required for the particular, which might not be required for a particular ailment to the patient, but they are still conducted just for solely for the purpose of claiming insurance claim. Third is rejecting other medical reports or diagnosis, which we have already discussed. So what happens is whenever you visit a doctor and you go for a second consultation, it is a very usual practice where doctors reject or they say that this particular report is now not valid and you might need to get it redone. The fourth is incentive to medical practitioners, which is again which is called patient referrals. So doctors usually recommend particular hospital or particular medicine to take care whenever a patient visits doctor or practitioner. The next is identity theft. This is usually done in remote areas where the hospitals over there. Hospitals usually what they do is they procure the IDs of the genuine patients from the open market, and then they using those IDs they claim benefit from the government. Invoice manipulation is again one way of uh, committing a fraud where heavy discounts are utilized when a particular case is identified where cash receipts are more. So that is another way of committing fraud. Coming to detecting healthcare frauds. How can we detect healthcare frauds? So we can detect healthcare fraud through detective investigation and account auditing. These are the two approaches which are broadly used. Careful investigation reveals suspicious policyholders and fraudulent insurance program. Usually it is done in a case where there is a shortlisting of claims and having suspicious activities. So shortlisting of claims include where there are a voluminous nature of transaction, but a patient has been, let's say when a patient has been uh, taken to a hospital only for a day, and the hospital shows in the report that the patient was admitted for 5 days, and they claim the from the insurer the billing for 5 days. So this is something which is of a nature that could be identified through account auditing, that a particular patient, we can check the registers over there, that whether when was the patient came in, when did the patient went out. So this is another way. There are also so many analytical processes which are often used to generate audit shortlist. Besides, fraudulent claims often leaves pattern over time, which can be easily detected using predictive models. So analytical processes or probably data analytics is something which is recently gaining too much popularity. So when we talk about the hospitals, there is a huge amount of data that is involved in the huge amount of data and transactions that occur around the year. Gaining a comfort over 100% of the population is actually not possible because of the nature, timing, and extent of the audit procedures that auditor has to perform. So there are multiple processes, maybe test of detail, analytical process, data analytics, those are applied. So what analytic process help us is, or probably data analytics help us is, to identify those transactions which are not of routine nature. For example, let's say there are a couple of transactions which are not authorized as per the authority metrics. That's how analytical processes or data analytics help us in terms of identifying such fraudulent transactions. Prevention of healthcare fraud. How can we prevent healthcare fraud? So numerous cases of medical fraud and abuse can be avoided by ensuring that all the patient's information submitted is correct and the services or procedure carried out are merely in the interest of the patient. Before evaluating the patient health and during information submission, the following points must be kept in mind. First, is the patient actually registered and whether the eligibility is verified? So first of all, we need to check is whether did the patient actually came in, whether the profile was actually genuine, that the patient visited, took the treatment and then went out, or is it a fake profile? The second is the identity of the patient verified using photo identification, PAN, Aadhaar, or other documents? The third is the medical procedure recommended really necessary? So it is actually difficult to identify when a particular practitioner recommends that a procedure is necessary or not, but that could be from the past experience, from the past knowledge, and this could be tested. So usually there are multiple reports available which suggest that which all procedures are, there's a standard policy which all procedures needs to be performed in case a particular ailment is identified by a doctor. So that could be one way to identify whether the medical procedure recommended was really necessary or not. The next one is, are there accurate ITGCs and diagnostic codes? So usually hospitals have ITGC. ITGC is internal general controls. So hospitals management has to prescribe IT controls which are over there, and their particular diagnostic codes. So whether the billing for a particular ailment, for a particular test, is aligning with those codes, and the charges are as per those codes, or standard charges are as per those codes or not. It should not be like whether a particular the procedure performed or the test performed is something different and the charges are of something different. Is the length of the session accurate and the session dates are correct? So another way to identify is whether, let's suppose there is a fever case, or probably there is some particular ailment for which a patient came in. So what is the usual tenure for that ailment to get cured? So whether the patient was there in the hospital for that particular tenure or not. So that could be easily checked. In case if was an early relieving, whether there was a proper explanation, proper approvals were there or not. This could be tested. Whether the services were billed, were actually performed. Again, this could be tested. Whether the patient came in. So all these together can be performed to identify whether whether the patient visited in, whether the treatment was properly given, whether the invoicing was properly done, whether the collection was appropriately deposited in the accounts, and whether the same has been recorded in the books properly. Next, coming to the roadmap of the today's session. So we'll be segregating the session into the 4 parts. The first one is, first of all, understanding the legal structure and the financial statements. So how the structure works. what are the components in case of a healthcare sector which are included into the financial statement, how we identify a risk, what would be the audit approach, and usually what are the practical issues which are identified while auditing the healthcare entities. So we'll be going through all these one by one. The first is fundamentals of healthcare revenue, which are the parties that are all involved. So parties to a revenue transaction. We'll try to cover all the parties, majorly that, or probably the terminologies which we usually see while auditing a healthcare sector. The first one is, what are the parties to a revenue transaction? So a unique aspect of healthcare operation is that revenue transactions typically involve more parties than a traditional buyer and seller and vendor. So in a usual business, there is a buyer, there is a seller. In a service transaction, there is a service taker, service giver. But in case of a hospital, there are multiple parties involved, which are the individuals who receive the care, which is usually a patient, the physician who performs the service and or the orders the service on behalf of the patient, that is a practitioner usually, the healthcare facility, which is the hospital or probably the home health company that provides the setting, example operating room, or administers the treatment, and nursing or post-operative care. If applicable, a third party pays the provider on behalf of the patient, that is the TPAs basically, or the insurance companies. Fifth one, if applicable, various intermediaries such as managed care organization, physician practice management companies, or accountable care organizations. The patient may not be able to interact or even be aware of all these intermediaries, although they may influence both the type of care received and amounts being paid. So talking about the fifth line over here, so it could be a hospital where all the services are provided holistically within the hospital, or it might be a small hospital where they have collaborated with the other laboratories or physicians or doctors, where they might get third parties included to provide the following services. The next is patient billing system and gross charges. So these are a couple of terminologies which will go frequently when you will be doing test of detail. So what is gross charges? So when services are provided to a patient, the standard charges, often referred to as gross charges or established charges, associated with the encounter are entered into the patient billing system. In more complex setting, each input used in the process of providing care will be priced based on the established charges. So hospital industry, there is a usual terminology that they use while making the invoices or probably doing the billing. So gross charges are nothing but gross charges is a compilation of all the amounts for different type of tests or services that are provided by the hospital. It may be OPD charges, it may be IPD charges, it may be a couple of tests, those have maybe doctor consultation charges or third party that have been brought in to support, or it may be medicine charges. So, for example, if a patient requires stitches for an injury, charges could be generated for a structural kit, local anesthetic, syringe, bandages, and physician time. Thus, gross charges are internally recorded as the services are rendered. The data is used to create itemized bills showing all goods and services provided to a patient during an episode of treatment. So, again, this example replicates all those services that are provided to a patient, which form part of the gross charges. Continuing, who are the customers over here? In healthcare service transactions, the fundamental contractual relationship is between the provider and the patient. The provider provides the service and the patient agrees to pay for those services. Unlike customers in other service transactions, however, patient may have little involvement in selecting and paying for the services they consume. This is because services generally are performed or ordered on the patient's behalf by licensed medical professional, and some or all of the payment comes often from a third party payer. So what we are talking about here are healthcare patients who are actually customers per Ind AS 115. So who are customers over here? So usually a customer is someone who takes the service, accepts the service. But over here, although the patient is accepting the service, but usually the services are recommended by the healthcare professional, which is a doctor in this case. So the next is payers of healthcare revenue. So who is a payer of healthcare revenue? Relationship with a third party payer, which is usually an insurance company, or when patients are uninsured, then that could be a private pay case, play a significant role in how healthcare is purchased. Consequently, those relationships have a significant impact on how much revenue a provider will earn. Third-party payers typically do not pay the healthcare entity's established rate. The amount paid may be based on the government regulations, negotiated in-network prices, or the specific commercial health insurance policy or the employer's plan design. So what happens is when we talk about the insurer insurance companies or probably third-party players who with whom the patient usually gets the medical insurance, they pay to the hospitals at a prescribed rate. So usually when a patient is directly paying to the hospital, they might be paying something different, but when an insurance company is paying, there might be certain discounted prices that have been agreed between the hospital and the insurance company, which is paid by the insurance company to the hospitals. So you might observe frequently that the amount for that the billing or probably the realization by a hospital from a patient in case of a direct pay as well as from the insurance might differ from for a similar service. That could be very well checked from the agreement itself in terms of between the hospital as well as the insurance company. Now, coming to segment one, we'll try to understand the legal structure and how the financial statements of a healthcare company usually look. So, when we talk about categories of hospital, as I said, these are basically divided into two categories. One is publicly owned hospitals, which is AIMS, for example, Sir Gangaram, or probably Safdarganj Hospital, or probably a private hospital, which could be Fortis, Medanta, Artemis, and there are a couple of NGOs as well, and not-for-profit hospitals, which could be any charitable hospital run by an NGO. So, what are the basis type of healthcare hospitals provided, such as general medical and surgical hospitals, clinics, dental laboratories, psychiatric hospitals, hospices and palliative care centers, centers for emergency and other outpatient care, blood and organ bank. So, basically, all these are healthcare entities which operate on a different platform in terms of providing different services. So hospital may provide all these services, and there might be hospitals which might tie up with all these particular service providers in terms of providing the services. Coming to financial statements of hospitals, what are the financial statement linked items and what are the associated risks with all those financial statement linked items? So if you see it, the balance sheet of a hospital, this is just a template in terms of how a balance sheet of hospital might look like, and this considers of the liability side. So you would see that it is not as much as different from compared to the other industries balance sheet. It has same equity share capital, reserves and surplus, long-term borrowings, taxes, other long-term liabilities, provision, short-term borrowings, trade payables, current liabilities, and provision. But when we talk about the audit procedures associated with all these financial statement linked items, they are considerably different compared to the other industry, which is usually the case. So let's talk about each individual item and the associated risk in terms of hospital sector or probably a healthcare sector. So first, shareholder equity. So being capital intensive, hospitals require a lot of funding, and generally this comes out from promoters, public trustees, large private equities, or compound financial instrument. So hospitals require a lot of funding in terms of getting the facility development because there are a lot of compliance requirements. So fulfilling all those, getting licenses, setting up the proper setup, all these require a lot of funding which comes through promoters, public or trustees. It could be private, it could be government, through bonds, depends. And what are the associated risks which are usually seen? The first one is incorrect accounting. As we discussed, incorrect accounting is first associated risk over here. So funding in bringing in this much amount of cash, so the hospitals might tend to use malpractices in terms of reporting. So or they get all the compliances. There's a huge amount of bribe involved that sometimes, which is over there in terms of getting the licenses. The second one is pressure to buy shares from promoters or PE fund or bring in IPO. Another pressure is over here. Promoters might want to move out of the hospital, and because of that, they might pressure the hospital to raise in the IPO. So this is another place where there is an associated risk involved. The third one is pressure to show growth and profits based on the business projections shared with the investor. So hospital might also be in pressure because what happens is whenever hospitals reach out for funding, they have to show the projections. So to meet out those projections, they might there's always a risk that there's a risk over the hospital in terms of showing the growth or probably inflating the revenue, deflating the revenue in terms of curtailing the profits. So there is always a risk involved. The next one is borrowing. Most of the funding, including equipment funding, are met through borrowings from bank, financial institutions, or other models. And the risk associated with this are risk of breach of financial covenants, payment defaults, use of funds. So what happens is whenever banks are involved or probably any financial institutions are involved in terms of funding, these all funding requirements comes along with some covenant requirement that that the hospitals have to meet couple of covenant or ratios requirement that they have to maintain this much amount of cash at any point of time, that there is no default in payment, and the funds might be, there might be certain restrictions that the fund should be used for a particular purpose, which the hospitals have to do. The next one is provision and liabilities. Provision for restoration of public-private partnership and the associated risk, whether it is risk of incorrect evaluation of agreement and obligations under the PPP model. So there is always a risk that the agreement has not been properly evaluated. And when we talk about government and private players coming in, so together to run the hospital, there is always a pressure in terms of the private companies to take in the profits, and for the government there is always a pressure to provide the services. So there is always a risk that the agreement has not been properly evaluated in terms of how the services needs to be provided. One of the very significant or common risk associated over here is that the government hospitals usually reserve beds for the common people at large, whereas the private players usually tend to provide it to the people who are paying for it. So when these two entities come in together, there is always a risk that both of these things are properly managed or not. The next is liabilities includes government grants, lease liabilities of hospital payable to MSc vendors, and doctors payout. So with liabilities, there is always a risk with respect to government grants. How the risk associated with the government grants are usually grants are provided with specific restrictions that the amount needs to be spent in a particular manner along. And the governments had to take hospitals had to take care that they are spent accordingly. So this is one thing that needs to be checked in. The other is lease liabilities of the hospital. Usually there is a huge amount of equipments, those are taken on lease by the hospitals. So whether those all those ROUs, lease liabilities, have been properly recognized or not. The third is payable to MSME vendors. So when we talk about MSME vendors, these are all small players which provide different kind of facilities to the hospital. As per the MSME Vendor Act, all these vendors needs to be paid on a particular date. Otherwise, there's a liability from the governments. There's a liability in terms of interest that needs to be accrued, and there is a specific disclosure requirement in the financial as well. So what usually the hospitals do, or probably what's the common practice, is not properly classifying the MSP vendors and not properly disclosing their interest that is due on account of delay in payments. And again, doctors payout, whether the doctors are being paid as per the agreements or not. So we have already covered the liability section. Coming to the asset side, so all these particular line items are usually seen on the face of the balance sheet in case of asset side, which includes tangible and intangible assets, capital work in progress, other assets. There could be investments, deferred tax assets, long-term loans and advances, other non-current assets, investments, inventories, trade receivables, cash and cash equivalents. So let's talk about all these one by one. The first is property, plant, and equipment. So property, plant, and equipment comprises of land, building, medical equipment, operation theaters, leasehold improvement, ventilators, ambulances, etc. in case of hospitals. So usually the risk associated with in case of PPE is first impairment of assets. So let's say the particular hospital is not able to run in profits, or the particular department of a particular hospital is not running into profit. So there is a high chance that the assets needs to be impaired. The second is impairment of hospitals. So when we see hospitals as a whole, there might be a chance of impairment of hospital, and when we see the departmental level, there might be a chance of particular department impairment at a CGU level. The third is legal title of land and buildings. Again, hospitals are given lands on a concessional rate by the government. So there might be some dispute between hospitals and the government, which is out there. So that could be checked through floating of confirmations to the legal law firms of the hospitals. The next is effect of business combination. So there might be a scope that hospital has entered into a control ownership of particular healthcare service, healthcare facilities provider in that same state or city, or to a different place. So these are, whether these transactions are properly accounted in the books of accounts of the hospital is again a riskier area. Coming to intangibles, operational management rights, goodwill, and from business combinations, trademarks, service agreements, non-compete fee, other special nature software, and license. So again, with intangibles, there is significant risk of impairment because whenever any business is not performing well, intangibles are something that are impaired firstly. Let's say there is a business combination that has happened because of which a goodwill has came into picture. Whether the goodwill has been properly accounted for, whether the particular that entity that has been occupied, whether that entity which has been merged on account of business combination, if it is not working properly, if it is not in profits, then there might be a need for impairment in that case. The next is investments. So investment in group companies and other entities, funding arrangement to group companies like CCD, OCPS, CCPS, and other hybrid arrangements. So whenever there is an investment in a particular entity, we need to see that whether there is a need for impairment again over that entity, whether that entity is performing well in terms of business, whether that entity is profitable, whether that entity needs to be impaired or not. So that needs to be checked. The next is trade receivables. So trade receivables could be from government or semi-government authorities like ESI, CGHS, PSUs, trade receivables from insurance companies and TPAs, and from corporate group companies and others. So what are the usual risks associated in case of trade receivables? So in case of government trade receivables from like ESI, CGHS, PSUs, there is a high risk of collectability. There might be a delay. So if you see, hospitals are a highly leveraged entities. So there is a high likelihood that the payments might not be realized on time, because of which the operations of hospitals might get impacted. The second one is trade receivables from insurance companies. So insurance company usually makes the payment in bulk, and there might be a delay in terms of payment from insurance companies as well. So that is another case. The third one, when we talk about corporate group companies and other, this is a more easier trade receivable to gain comfort on, but compared to the other two, since when we talk about the first one, in case if we are raising independent balance confirmations, there is a high likelihood that the confirmations are not received from the government or semi-government authorities. Even that insurance companies sometimes provide confirmations and sometimes do not provide independent confirmations. So again, there is a high risk involved in terms of trade receivable. So the usual risk are risk of recoverability from government agencies, reconciliations, confirmations, and testing of existence. So reconciliation could another be an issue, because what happens is when the hospitals submit their claims to the government agencies or probably to the insurance companies make the payment in a wholesome amount. So reconciling that amount, whether all the amount have been recovered from the insurance companies or probably the government or semi-government authorities, is a big task. The next is inventories. OPD and IPD pharmacy, expiry of stock and replacement arrangements, accounting of credit note from pharma companies. So when we talk about inventories, usually there is a less likelihood in terms of medicines, because usually the medicines are replaced by the pharma companies at a free of cost basis. But again, there is a risk associated with respect to overvaluation or impairment in case of inventories. Inventories, it is not necessarily should be of medicines, but it could be of other medical equipments as well, and these might get outdated or get wear and tear with time, which might be carried over at the same amount in the financials. So there is always a risk associated in terms of valuation of inventories. The next one is other assets, loans and advances and other funding arrangements, example unbilled revenue. So there is since I already said that the hospitals are a very highly leveraged entities, so there is always a risk of overstatement of AR and revenue. So this is how the profit and loss account looks usually of a healthcare company. It might not be again different, but in terms of audit procedures, the audit procedures are comparatively different in terms of a regular industry. So let's cover each one by one in the next slide. So first of all, revenue from operations. Again, first is outpatient department or OPD billing, inpatient department billing, room rent, ICU charges, doctor and nursing charges, medical and consumables, investigation charges, and procedure charges. So when we talk about outpatient billing or OPD billing, it usually consists of the consultation charges whenever a patient visits the hospital and gets a consultation, that is captured over here. Inpatient department billings are basically IPD billings where a patient gets admitted to the hospital, and any kind of services provided over there would be covered under the inpatient department billing, which again includes room rent and ICU charges and all these. The next one is sale of pharmacy, both OPD, over which the GST is usually available, and IPD, which is usually exempt from the GST. Others is renting of hospital premises to food vendors, renting of space for parking, medical equipments, etc. So when we talk about these days, the concept of hospitals has also changed. If we see that the hospitals have so many restaurants, it might be a food court at the reception lobby side of the hospital, and there might be agreements with all those vendors in terms of providing all these spaces at rent. So there might be revenue activities from that as well. The others are beauty care, plastic surgeries, etc. So usually beauty treatments, plastic surgeries, they also form part of the revenue model of the hospital. So what are the major streams through which a hospital recovers its revenue? First is oncology, cardiology, orthopedic surgeon, gastroenterology, family medicines are usually the top performing departments of a hospital, which have high margins and volumes and constitute majority of the revenue. Now looking at the cost components. So what are the cost components when we talk about the hospital sector? The major fees is doctor's payout, which constitute almost 60 to 70% of the overall cost of the total P&L. So doctor's payout, usually on revenue sharing or minimum guarantee, can have multiple variants. This is the largest cost in the P&L. So doctors might get associated with the hospital on a revenue sharing model, or they might have a minimum salary, which is usually in case of a government hospital. So there might be different models in terms of doctor's payout. The second is cost of medicines and consumables, which is the second largest cost in the P&L. The third is nursing cost. Fourth, outside investigations, lab test reports, and others. Usually hospitals have in-house department for this. Depreciation of property, plant and equipment, equipment hire charges, and referral costs for acquiring business. Although referral cost is usually not allowed by Medical Council of India, but again, you might see in one form or the other, or you might be able to identify when auditing the P&L side of the hospitals that there is some incentive that is given to a doctor or a practitioner for acquiring business. Now we'll talk about common CAM points which are observed in the audit reports of the hospital industry, and why these CAM points are usually given. The first one is accounting for business combination under Ind AS 103 or reverse merger. So what we need to do is obtaining understanding of the transaction. So why the business combination was done. Second, allocation of purchase price allocation. So allocation of purchase price allocation is again a very, very crucial topic over here, because there might be a requirement at the auditor end that they need to involve an expert to identify whether the estimates used are correct or not, whether the valuation done has been properly done or not, and whether the goodwill has been properly arrived at not. Third one is review work of management specialist and the evaluation report. As an auditor, we need to look at the what management has performed, whether it's estimate, whether the projections, whether the evaluations, and so on. The next one is evaluation of appropriateness of accounting and disclosures. So we as an auditor also need to see whether the disclosures have been properly given as per the accounting standards requirement. So that is again a crucial thing. The next is other treatments, beauty care, plastic surgeries, etc. Whether these treatments have been properly recognized or not, how the billing are performed, how the cost have been recorded in terms of all these services, because usually here the cost is not directly directly allocated to the revenue as a percentage, or there is no specific cost, because it's all the service cost that is included in this particular section. So there is a high likelihood of manipulation, and discounts is also involved over here. The next is impairment of intangibles and trademark. So review if future flow forecast, review of assumptions and discount rate and long-term growth rates. So in case of intangibles and trademark, and while testing their impairment testing, we need to see whether the projections based on which all these have been recognized are proper or not, whether the estimates that have been considered by the management in terms of deriving out the numbers are reasonable or not. There might be a requirement to again include a expert in case the financial expertise is required. The next is review of estimates made by the management, and the third one is checked valuation reports and assumptions used by the management using in-house valuation experts. So there might be a scenario where in-house valuation experts are used by big audit firms. But in case if you don't have an in-house valuation expert, you can an auditor can always use a outside audit expert for gaining an opinion and getting comfort. The next is allowances for credit losses related to trade receivables. The first is review of controls and calculations prepared by management, or we can say ECL working. The second is verified credit report on sample basis, and third is recomputed the ECL working. So in case of credit losses or ECL, what an auditor needs to do is they need to see that whether the controls and calculations which have been prepared by the management are correct or not. Auditor can on a sample basis check for particular data, particular class of data, whether the assumptions used, whether in terms of calculating the provisions are proper or not, whether the credit reports are valid or not. In case if a particular trade receivable has a history of making late payments or not paying, then that could be checked by the auditor, and then checking whether the working computed by the client is proper or not. Fourth one is litigation matter, which is contingent liability from free treatment to underprivileged patient. This is again serious, grave concern, because usually in case of hospitals, you would find that there are a lot of cases that might be involved from patient side or third party side or maybe from government side. We'll cover here from the patient underprivileged patient side. So management inquiry and with legal department, what an auditor can do is auditor can, as a initial audit procedure of the planning stage, management auditor can inquire from the management as well as raise an independent confirmation to the legal department to identify all the legal cases that are pending and lying with the company. The second is check the progress of the cases. So in case if a case is long outstanding, it had been going on since years and year on year, auditor has a responsibility or onus to check the current status from the legal side, legal team. In case if it is an in-house legal counsel, an internal legal letter could be drafted. In case if it is a outside legal party that is handling the case, then independent legal confirms can be floated to those parties to check the current cases and to identify whether there is a probable, possible, or remote probability whether the case will materialize in favor of the hospital or against the hospital. Third is reviewed correspondences with legal counsel and the company and other documents. So auditor also needs to review the correspondence between legal counsel and the company. This could be usually done. First of all, what auditor can do is they can see the legal and professional expenses of the P&L, and from that identify if there is any significant amount of fee that have been paid to any of the legal third party and what are the correspondences between them. The auditor can also verify the agreement or probably see the invoices in terms of the nature of service that is provided by the legal party to identify such things. And the fourth one is obtained independent confirmations, which we have already covered. The next is impairment of investments and loan. So the first to cover over here is review the cash flow projections. So in case of investments and loans, what we can do as an auditor is we can review the cash flow projections. We can see the business plan of the subsidiaries, check the key assumptions which are used, which may be discount rate, growth rate, sensitivity analysis of the key assumptions, and also see in-house use in-house valuation expert to validate whether the projections are correct or not. The next is evaluation of uncertain tax positions. So what an auditor can do over here is obtain an understanding of the key uncertain tax positions and read correspondences with the tax authorities. And in case required, again over here, auditor can see the minutes of the board minutes in case to identify if there are any open tax positions or if there are any formal notice that have came in, and so on. The next segment is audit risk in healthcare. So what are the kind of risks that are over there in the healthcare? Although we have tried to cover couple of instances through camps which are usually seen in the audit reports of the healthcare entities, but now we'll cover over here in detail. So what is the usual process of risk assessment in case of healthcare industry? So what we do is, first of all, we identify the relevant factors which affect our risk assessment and develop a planned response to those. Then we see the size and composition of that account. Third is volume of activity that is processed through that account and the nature of the account and disclosure and measurement of uncertainty or estimates only. So this is although a common approach that we follow in terms of majority of the industries, which could be customized in terms of a hospital or healthcare sector. that how this risk assessment processes map exactly to the process that have been used at the hospital. So the key accounts usually over in case of healthcare sector are revenue and AR, because AR is something that is split over years in terms of collectability, and there is always a scope of overstatement or understatement of revenue. So basically, those two kind of accounts are captured over in risk assessment process, and there are definitely risk associated. But again, considering the size and complexity of the account, we see whether that account is a significant account or not. Now, what are the risks and what are the usual audit procedures that are applied? So first of all, going concern assessment risk. So this is by default a risk. This is why it is a risk because of the high leveraged balance sheet in case of hospitals, blocked working capital, and with long gestation period. So what happens in case of healthcare industry is their balance sheet is highly leveraged because majority of the funding comes in from outside through government, through banks, through financial institutions, through promoters, and that gets blocked in terms of infrastructure or probably PPE into the hospital. And since their AR is split over years on years, there is a long gestation period. So what are the audit procedures that we can perform in terms of getting comfort? First, identify parameters which indicate going concern risk like continued losses, whether there are continued losses, whether there is a negative cash flow from operations, whether the current liabilities are getting more, whether there is any default in salary payments to the staff, or whether there are any external dues or debts that have not been paid. So basically, to get a comfort over going concern, we try to see all the uh, leverage ratios. We try to see if there are any defaults in payments in terms of the outside parties or internal parties to gain comfort whether there is a risk of going concern. The second is obtain mitigation plan from management, like proposed infusion of equity, support from promoters, parent entity, new credit line approved, debt restructuring, cash flow projections for the next 12 months. So, in case if we identify in step one, there is a factor that shows that there is a going concern risk assessment, then we need to obtain from management the plan to how the management plans to mitigate that risk, which could be one way could be infusion of equity by the promoters or the parent entity, or probably that the banks are available to give credit to the entity, or they are ready to do the restructuring or cash flow projections that the entity is able to show that the cash flow projections are sound for the next 12 months. The third is apply professional judgment while evaluating the management mitigation plan and conclude accordingly. So, considering the above factors, auditor has to see whether the risks that were identified in step one are properly and thoroughly mitigated at step two. And if the auditor feels that the management has sufficient plans to cover the risk identified in step one, then we can identify that there is no going concern risk assessment, or we need to further dig in then. The second is management override of controls. So usually management is in a unique position to override controls and manipulate books and financial statements. And this could be very easily tested. So these days there is a new approach of doing the journal entry testing or data analytics, through which we can identify if the management has overridden and the controls have been mitigated, the controls have been breached. The first is test journal entries with 000 or 999 round figures passed on public holidays or weekends. So usually you see that when there is no operations conducted on Saturday and Sunday in terms of the finance account department side, or if even that is conducted, whether there is any transaction that has not been approved from the management side but have still been passed. The second is test general entries with unusual description. For example, as suggested by CFO, as suggested by CEO. So if there are any transactions that are of such nature or which consist of such narrations, that could be suspicious ones. You can test non-standard journal entries. So let's say an entry has been passed, asset account debit to liability account, or probably an account has been hit which should not have been hit. So that is a couple of instances where you can identify whether there is an override of controls from the management side. The fourth one is scan ledgers for unusual entries passed by the management. So ledger scrutiny, again, this is an older technique that was used to identify if there is a management override of control. The third one is compliance with laws and regulations. So usually there are n number of laws that are applicable for running a hospital, which in terms of compliance from government side is from various agencies. Plus, special attention is required for legacies and grants received and government regulations, EWS norms. So what we can do as a audit procedure is, first of all, obtain understanding of laws and regulations applicable to the hospital. So as a general practice, as an auditor, we need to gain an understanding of the entity before we perform an audit or before we start our audit. Similar is the case in case of hospitals or probably healthcare industry. We need to gain an understanding of the entity, how it works, what are the major laws and regulations under which an entity is working, and whether all those are in compliance or not. The second is review compliances presented to board by the company and assess the non-compliance and its impact. So another way to identify whether the compliance is done or not is you can always reach out to the company secretary or probably the legal side, or you can visit the board minutes to check whether the compliance have been properly done or not. Review the legal and professional expenses to identify any new notices or legal action taken against the hospital. We have already captured whether how we can leverage the legal and professional expense of the P&L to identify if there are any particular costs that have been incurred. For example, we can take one example over here. So let's say a penalty has been incurred in terms of uh, paying to the government, that is coming out through legal and professional expense. So as an auditor, we can always inquire what was the nature of the penalty, why was it paid, whether there was a non-compliance in terms of any laws and regulations, and which might have a significant impact on the financial statements. The next is impairment assessment of PPE departments and hospitals. So the background over here is, in terms of PPE, the carrying value of the asset is more than its fair value or projected cash generation capacity. So basically, we see this in impairment as well, whether the value of the assets, the fair value of the assets, is less than the value being carried in the books. That is what triggers the impairment. So what are the audit procedures that could be done? First, assess the cash flow projections given by the management associated with that PPE or the department or hospital as a whole. So what we can do is, on a second, we can see the cash flow projections given by the management. Cash flow projections are anyways taken in the going concern assessment as well, or probably in case of impairment as well. The second is test the key assumptions used by the management. Auditor has to check whether the assumptions used by the management are proper or not. So let's say the company, the entity has given us a projection of 5 years. So the rate at which the revenue is increasing, the rate at which the cost is increasing, whether the same are in line with the expectations developed by the auditor or probably by the trends of the past. So those could be tested. The third is involve external or in-house valuation expert. So in case of auditor feels that something is more technical or something is there which requires external or in-house valuation expert, then that the same could be also be appointed to gain better comfort. And the fourth is perform necessary checks to see if there are any further procedures that are needed to check whether there are impairment requirement is over there or not. The next one is creation of deferred taxes on business losses. So usually the entities prepare book DTA in their financials, even though they do not have a visibility in foreseeable future whether there would be profits or not. So that is something really crucial that needs to be checked. Again, it depends upon the testing of estimates over here, because the projections would be used in terms of seeing whether the entity would be in profits or not in the future, and again that would involve audit of the estimates. So there is a high probability of entity creating deferred taxes on losses. So one should check the reasonable certainty versus virtual certainty. So reasonable certainty needs to be checked in case if there is an Ind AS requirement, and virtual certainty in case of an IGAP requirement. So this is a basis the applicability of the accounting standard. This could be checked. Second, obtain future cash flow projections from management for validation. The third is inventory management and verification. So again, inventory is a crucial financial line item in the balance sheet of a healthcare sector. And what audit procedures we can perform over the same is, first, check aging of the inventory and expiry management with the vendors, expiry arrangement with the vendors. So one should evaluate in how old is the inventory lying in the books of accounts. So their inventory is usually tagged in terms of when it was procured, and through aging we can identify if it is lying for more than the period specified, or maybe its age. So in case if it is lying for more than the life of the asset, it needs to be provided for through provision, or it needs to be written off. Also, we can check as an auditor whether there is an arrangement with the vendor in terms of replacement at a certain cost or at a free of cost, which is usually in case of medicines. Hospitals have an agreement with the pharma companies that the medicines are replaced by the pharma companies at a free of cost. The second is perform necessary stock counts at the year end. Considering the requirement, considering the scenario risk associated with the inventory, it could also be performed at a mid of the year, or probably basis the requirement it is done, but usually it is performed at the year end. Third is separate valuation for IPD and pharmacy inventory. So valuation for IPD and pharmacy inventory is done differently because usually GST is involved in case of inventory that is lying over the for the OPD at pharmacy, and for IPD usually GST is not there. So again, valuation is something that needs to be considered. Fourth is recovery of trade receivables and confirmations and reconciliations. So AR again related with the revenue is a crucial area that is the most critical one in terms of the healthcare sector. So we'll spend some time over in terms of how do we audit the trade receivable in terms of healthcare industry. So the first is adequate policy for long outstanding trade receivables and the ECL model. So usually the AR consists of the AR might be from ESI, CGHS, which are basically the government companies. So let's talk about the government companies. So it is very difficult to obtain independent balance confirmation from the government companies because there is hardly any responses in usual scenarios. So how do we go ahead in that case? So in that case, what we can do is we can check the previous realizations in terms of, let's say an AR was recognized in a particular year, after how many, in how many years the same was recovered. That recovery percentage could be applied to the current AR to identify whether the AR has been recorded at a proper amount or not, or whether there is a provisioning requirement. So this is something that could be done, whether the credit loss has been properly booked or not in terms of the realization from the government companies. Again, as I already said, that the recovery from government agencies, insurance companies is comparatively different to what is done from the patients directly because there is a discount involved over there. Second is in terms of insurance companies, AR from insurance companies. So insurance companies usually provide the balance confirmations, but again, it is very difficult to map the balance, the confirmation amount provided by the insurance companies with the balance appearing in the books, because there might be n amount of data. Let's say there is 20 million of data appearing in the books of account, but the insurance company has confirmed that it's only 15 million. So there might be a couple of invoices that have not been processed by the insurance companies till yet, and they might not provide the reconciliations. So this is a very getting reconciliation from the insurance company, or maybe preparing the reconciliations, again a very difficult task in case of healthcare companies. So again, using past trends to identify how much collection could be done against an amount of AR that was pending could be a way to identify whether the AR has been properly recorded in the books of accounts, irrespective the confirmation is not mapping to the balance in the books. So this is an alternate procedure that could be performed in case the primary audit procedure fails. Third one is from the corporates, which is basically the corporate companies which take the insurance in case of in-house. In-house, they have in-house departments. That is a more easier one because they usually provide the independent balance confirmation, and it is easier to reconcile as well because the quantum of claims lost by them is comparatively lower. The second one over here is special focus on deductions and reconciliations. So what are the kind of deductions that have been provided by the hospital to the AR? Whether the deductions are in line with the agreements. So whether whatever amount they are billing to the insurance company or to the government are in line. So this also needs to be checked. The third is special focus on recoverable from ESI, CGHS, and PSUs we have already covered. Fourth is practical challenges while performing alternate procedures for not confirming debts. So as said, in case if we are not receiving the balance confirmation, let's say if we are not even getting the reconciliations, in case if we got the confirmation and the balance is not reconciling, then what alternate procedures need to be performed, that needs to be looked at. So using past trends in terms of collectability could be one way to identify and gain comfort over the AR. So the next is revenue. So there is always a risk of overstatement or understatement of revenue, and this is always there. There is a high chance that revenue is always a fraud risk. So why do the management needs to overstate the revenue? Management might need to overstate the revenue to align their results with the projections they have shared with the promoters or the outside parties, or they might understate the revenue in terms of curtailing the profits, in terms of saving on taxes. So it is presumed that revenue has some element of fraud, and there can be either overstatement of revenue or understatement of revenue, as the case may be. Audit procedures. So what kind of audit procedures as an auditor we can perform? We can obtain understanding of all streams of revenue, that is OPD, IPD, pharmacy, investigations, etc., including the IT system around revenue generation, HIS testing and accounting system testing. So in case of an entity which is significantly large and where there's a complex accounting structure, an auditor can involve the IT auditor in terms of testing the IT controls, and then probably it would significantly reduce the efforts of an auditor. But in case if it is a smaller entity, then auditor can perform the routine transactions by just understanding the type of streams of revenue, whether it is an OPD consultation revenue, IPD, which again involves the in room charges, ICU charges, or pharmacy charges, etc. The second is perform test of details using appropriate sampling techniques, OPD revenue and IPD revenue. Test unbilled booked in the year end. So what in when the in case if IT control testing is required and that have been conducted, that gives more comfort to the auditor. But let's say there was no, it is a mediocre entity and there is no IT controls testing requirement. The auditor is doing the general testing of the controls. In that case, auditor can perform the test of details using sampling technique. Since the transactions that occur over the year is voluminous, auditor has to select the samples. So what auditor can do is auditor can divide the population into OPD, IPD, pharmacy, investigations, etc., or probably ICUs, and divide and pull out samples from each of the homogeneous population. So the coverage is from all the streams of revenue, and there is a less likelihood that a particular revenue of the stream of revenue transaction is left by the auditor. Auditor can also test unbilled booked during the year. So unbilled revenue is something where the amount has been received, but the services are yet to be performed. The next step is perform analytical procedures like reconciliation of revenue generated with cash collected, credit card collections, consolidation issues, revenue generated per bed versus per day versus comparable period, month on month occupancy levels versus revenue booked, department wise revenue generation versus cost incurred. So what auditor can do as a process of analytical procedures is auditor can divide the streams of revenue into different categories and then perform whether and see whether the per day patient revenue last year was same compared to the current year. If it is same, then it's fine, or if it is somewhere nearby, it's fine. But can investigate in case if it is varying significantly, what has changed from last year that the per day revenue has increased or decreased. This could be done for comparable periods or for a couple of periods to say how much increase had been there and whether the increase is as per the expectation set by the auditor. Month on month occupancy level versus the revenue booked. Auditor can also check whether the occupancy in a particular month was more but the revenue was less. That would give an indication whether there might be a chance of uh, manipulation by the management. Department wise revenue segregation versus the cost incurred. This could also be done to see whether a particular department, let's say for example there was a 100 million cost in 100 million revenue generation in previous year, and the usual cost is 60% to that for that particular department. So in the current year, in case if the thresholds vary, then auditor can investigate into that. The next is consolidation issues. So loss-making entities are removed from the group to manage profitability, complex business combination like slum sale, mergers and demergers, BP on asset acquired. So what usually is done is sometimes it happens that the entity leaves all those smaller entities in of consolidation which are not profitable just to show inflated profits or better business position. So what are the kind of audit procedures that we can perform over there? The first one is perform control evaluation as per the requirement of accounting standards. So we need to check whether that entity needs to be consolidated as per the accounting standard or not. So we need to see whether there is a control which is over there by over the entity or not. So control evaluation is something really crucial. The second is involve valuation expert to assess the purchase price allocation. So in terms of a business combination or consolidation, we need to identify whether the valuation have been done properly or not. So, and if required, whether we can involve an expert to identify that the valuations are correct and gain more comfort. Ensure accounting is in compliance with the accounting standard. The next is completeness of provisions and liabilities which are booked in the books and contingent liability. So how we can gain comfort over provisions and liabilities? So audit procedures associated with it are check agreement with doctors and understand the key terms. So what auditor can do is auditor can go through a couple of agreements with the doctors and see whether the payments are being done as per the agreement or not, whether there is any liability or whether there is any requirement that needs to be provided for in the books of accounts or not. The second is check agreements with other service provider to understand the key terms and complexity involved. For third parties, where let's say an entity or a hospital is having a tie-up with a laboratory, so whether all the payments or all the services that are taken from that laboratory are properly accounted for or not at proper prices or not, and whether if there is any further covenant requirement or there is any particular scenario that is over there in the agreement is managed or not. The third is perform completeness check for cost booked and not booked in the financial statement. So usually we perform a testing of subsequent transactions. So we take the dump after the audit period ends and see if there is any transaction that pertains to the current year. That could be done to identify if the provisions are complete or not. This we do as a part of cutoff testing as well in terms of revenue. And in terms of contingent liability, we can always get comfort by raising independent confirmations to the legal party, legal in-house counsel or outside counsel to understand whether there are any contingent liabilities involved or not. This could also be done through audit of the legal and professional expenses in head in the financial statements. The next is inventory management and verification. So what about the inventory? So when we talk about inventory, again, it comprises of significant, this is a significant account in the balance sheet. So what audit procedures can we perform? First, we can check the aging of inventory and expiration, perform necessary stock counts, separate valuation for IPD and pharmacy inventory. Impairment assessment of PPE and AR we have already done. Now we are coming to audit approach. So what audit approach we should follow? So although along with all the risk associated, just to give a holistic view, we have already covered what are the usual audit steps that we follow in terms of a particular risk associated with the particular financial statement line item. But over here, we'll talk about a macro process in terms of how do we develop an audit approach. The first is understand the scope of the audit or review engagement. We need to understand what we all need to do as an auditor. So for that, we do have our engagement letter in picture, which we need to sign and get countersigned from the client. So what all procedures are required in terms of understanding the scope of the audit or review engagement? Client acceptance procedures, whether the client has accepted our engagement letter or not. Ensure independence and ethical requirement. We need to ensure that we as an auditor and the persons who would be working on the audit are independent and there are no ethical breach. The third is agree commercials and sign engagement letter. Audit fee should not be contingent upon findings. It should always be in absolute terms and agreed initially before the conduct of the start of the audit. Assess the audit requirements. We need to identify what all audit procedures need to be performed in terms of the required scope. Assess the staff requirements, how many people would be required and whether an expert would also be required or not. Also, we need to identify whether the audit is whether it is a complete audit, scope is a complete audit, or if it is a review, or if it is something else. So we need to identify exactly what is the scope of the engagement and the relevant procedures are performed. The second step is to identify the risk. How do we identify the risk? We identify the risk through understanding the entity and its environment. Control environment ELC, control environment, entity level controls and other controls, IT system, business of the entity. Identify risk including risk of material misstatement and fraud risk, and identify complex transactions during the year and related party transactions. So identifying the risk is again a significant process of the audit approach since after that only we will be able to determine how deep we need to dig in as a part of the audit process, whether we need to do more sample testing, whether we need to do control testing, whether we need to perform extended procedures or not. So all this forms part of the risk assessment. Then, basis the risk identified, we design the audit response. So based on the risk, develop an audit strategy which is mixed of substantive and analytical procedures. Decide nature and timing of testing, interim audit, quarterly audit, concurrent audit, or year-end audit. So basis the risk identified, we'll develop how much substantively we need to check, how much analytical procedures could be performed in terms of financial statement line items which are not of significant risk nature. And we need to also see, considering the size of the engagement, whether we need to perform an interim audit or quarterly audit or concurrent audit or year-end audit. The next step is obtain audit evidence. So this is on ground doing the audit. So what we do over here is we do the test of controls, substantive procedures, analytical and substantive, and data analytics procedures. And post that we go for the audit report. The fourth step of the segment is obligations to regulators, EWS and other commitments, operation management agreements, and to Ind AS 110 control evaluation, referral cost, inventory verification, trust arrangements and structuring, non-paying and non-conforming trade receivables, low value bills, and high volume of revenue bills. So these are some practical issues which we face while auditing the healthcare sector. So obligation to regulators. What are the obligations to regulators? So what happens is when the healthcare industry or probably the hospitals take land on concession or probably facilities from the government on concession, there are sometimes covenants or probably requirements where the hospitals have to reserve, let's say, 25% of the beds for the common people where they'll not charge anything. So this needs to be checked, and this was recently brought into the news as well, that one of the private player did not reserve the beds as required by the government regulation. So hospitals are bound when dealing with the government, they are made to reserve a couple of beds or facilities for the people who can't afford, or for probably for the general people at large. So whether all these obligations are fulfilled needs to be checked by the auditor, and the onus falls on the auditor to report all these things. So in case, let's say, if there is a default which have been highlighted to the government, so the government will not only punish the entity but also the auditor, that the same was not highlighted by the auditor. So considering it is being it is being required as an obligation, the auditors should be very skeptical while doing audit for these things. The second is operation and management agreements and Ind AS 110 control evaluation. The second is we need to test as an auditor whether there is a control over an entity because of which the consolidation is required as per the Ind AS 110. So it is very significant because what can hospitals do is they can eliminate all those entities which are not profit making. So this control evaluation is something really important. Third, referral cost. Again, already discussed, referral cost is something being paid by the hospitals to doctors and practitioners to recommend particular medicine or probably the hospital. For taking one example over here is the example of Dolo. At the time of COVID, this was very frequently prescribed by the doctors to take Dolo. So and the company was paying heavy referral fee to the practitioners for recommending the same. Although this is not allowed by medical council, this should not be done by the hospitals, but again, as a requirement of the business or a business model, that is one way or the other being done. Inventory verification. Inventory verification again involves seeing whether the inventory of the pharmacy have expired or not, whether there is any other inventory that is lying that has got expired or not. Trust arrangement and structuring, we already talked about, where the lands or buildings or other facilities are taken from the government at concessional rates, and all the profits that are being taken out by those trusts are transferred to the private players through multiple arrangements. So let's say a trust has entered into an agreement with the private venture where they are transferring all the profits of the trust to through an arrangement where the trust is providing some facility and they are paying it at a huge amount of incentive or profits. Non-paying and non-conforming trade receivables. So trade receivables, there is a high probability that amount is not recovered from trade receivables, or probably the trade receivables are not recorded at a proper rate, and proper expected credit loss is not recorded in the books of accounts. The next one is low value bills and high volume of revenue bills. So there might be a scenario where discounts are adjusted into the bills. So and it is usually seen in case of cash transactions, where cash transactions are done by the patients. And so what hospitals usually do is they adjust the bill with the discounts, and this usually gets hindered, or this usually gets hidden in terms of high volume of the revenue bills. Now, how do we determine materiality? So materiality is again a concept, although again depends upon entity to entity. This might be a particular case that we are discussing over here, but again, these are just standard benchmarks which we usually use, but it may get changed basis the specific requirements of an entity. So usually we see that we take revenue as a benchmark when we deal with the hospital industry, because revenue is a factor that with which everything is aligned over there. So to see benchmark, we need to see where is the focus of the stakeholders is usually are. So in case of hospitals, the focus of the stakeholders is usually on the majorly on the revenue, and hence revenue is usually considered as a benchmark in terms of determining materiality. Again, in terms of level of benchmark, I guess this is very common, and people understand that we determine that 75% of the we take 2 to 5% of the revenue as materiality, and then determine 75% of the materiality as a planning materiality, and trivial amount could vary from 5% to 10%. Again, all these percentages are not anywhere recommended, but are standard in terms of uh, industry. This could vary based on the risk. So let's say if there is a high risk, then the percentage might be 1% of the revenue rather than 2%. So there is always an inverse relationship. So higher the risk, lower the materiality, and so on. So even the performance materiality could range between 50 to 75%, considering the risk. It could be even 50%, and similar goes with trivial. The next important topic to understand before I close this uh, topic is in network versus out of network services. This is something which is very frequently used, although it does not have that much amount of impact in terms of auditing. But as an auditor, we need to understand what is the impact of in network versus out of network service. So most health plans will establish a network of providers that have contractually committed through separate agreements with the health plan to provide care at discounted rates to the plan subscriber, member, or enrollees. The provider services are considered as in-network for patients that are covered by the health plan. Network providers are often referred to as participating providers. So, to give an example, what happens is insurance companies usually promote medical insurance by saying that in case if you subscribe at particular so and so hospital, you will get concessional facilities. The reason is these insurance companies have tie-up with those hospitals, and those hospitals provide services to the patient, or probably at a discounted rate. That's why these hospitals are called as in-network hospitals. And similar to it, out of network means where there is no tie-up of the insurance company with the hospital. So when a provider doesn't partner with your insurance company, your insurer is charged the full price for the services, raising your expenses as well. This is an out of network provider, and usually patients also feel struggle in terms of getting the insurance reimbursed in case of out of network provider. That's why it is usually preferred that patients visit in network, and that's why whenever there is a invoice that is for in network, there is always an agreed rate that needs to be looked at. So it would not fall under the general ambit where the prices could be mapped with the regular prices, but for in network there is a separate agreement of the insurance company with the hospital where the rates are aligned, and that's need to be checked in terms of verifying the revenue. Whether services are in network or out of network will affect the amount the provider can bill for services, the portion of the bill for which the patient will be responsible, that is the cost share with the health plan, and often whether the insurance benefits will be paid directly to the provider or to the patient. Amounts due from health plans are generally regarded as fully collectible, while amounts due from patient are less likely to be collected in full. So there is one example in terms of in-network versus out-of-network. So let's say hospital admits patient A, whose health insurance is provided by insurer X. Under the patient's A's terms of coverage, once the patient has met their annual deductible, insurer X will pay 80% of the negotiated network rate for in-network services, and patient A's co-insurance will be 20% of the network rate. Hospital also admits patient B whose health insurance is provided by insurer Y. Hospital is not a member of insurer Y's provided network. If patient B receives out-of-network care, insurer Y will pay 60% of the reasonable and customary rates for the services, and patient B's co-insurance will be 20%. So over here, if you see for patient A, with for whose insurer there is a tie-up with the hospital, the insurer is paying 80% and the patient just needs to pay 20%, which is usually the case. But in case of out of network, usually there is no tie-up of the insurance company with the insurer, and the insurer pays only 60% and the patient has to pay 40%. That too, there will be no discount involved since there is no agreement of the insurer with the hospital. So hospitals gross charges for both patient stays are 40,000. Insurer X negotiated network rate with the hospital for the services provided to patient A is 18,300. Patient A has met their deductibles for the year. Hospital requires patients that are out of network to assign their insurance benefit to hospitals. So this is all in terms of majorly all the topics that are covered, which are required as an auditor to focus upon while doing the audit of the healthcare industry. So I'm more than happy to take any questions if anyone has.
Thank you, sir. Can you hear me?
Yeah, I can hear you.
Thank you, sir, for such a wonderful deliberation. And it was a really wonderful and detailed deliberation. You have covered all the aspects of healthcare sector, all the aspects. I have received certain queries. If you permit, can I ask those queries?
Yeah, please go ahead.
Yes, sir. Sir, first question is, if we dealing in sale and purchase of medicine, is there a GST levelable if exceed the threshold limit in the hospital only?
So GST in terms of medicines is only applicable in case of OPDs and is exempt for IPDs. So if you see an invoice that is being raised by the hospital, so for consultations there would be a GST applicability, but when they raise an invoice for the IPD section, there are a couple of services for which those would be excluded when they are computing the gross. There will be a section for which will include GST, and there will be a couple of services for which there will be nil taxes.
So how best to cross verify pilferage of small surgical items in hospitals during audit?
So that could be done through inventory verification. So pilferage could easily be verified by doing independent inventory observations, probably, or surprise counts. You don't plan your visits to hospital when you want to do the inventory count, and that is the best way to identify if there is any pilferage or if there is any stock that is being taken out.
G. So how do we consider professional risk liabilities for major hospitals and individual doctors? At present, they have not seen covered significantly. The risk assessment in respect of above, how shall we consider, sir?
Sorry, sir, I did not understand the question. Can you come again?
How do we consider professional risk liabilities for major hospitals and individual doctors?
Okay. So when we talk about individual doctors and considering the risk associated with them, so usually whenever a doctor enters into a collaboration with any hospital or they get engaged with any hospital, they sign an agreement with them. It could be basis the percentage of profits, or it could be basis number of surgeries, or it could be a minimum pay, which is usually salary, we call it. So we need to basically thoroughly go through the agreement to understand the type of arrangement the hospital has with the doctor, and accordingly reduce our risk. Hello?
You're not audible, sir.
Am I audible?
No, now it is fine.
Okay. So what I was saying was, what we need to do is, as an auditor, we need to go through the agreement that the a doctor has entered with the hospital. So whenever a doctor collaborates with a hospital or a practitioner collaborates with a hospital, so they enter an agreement. It could be basis the profit sharing, it could be basis minimum pay, it could be basis the number of surgeries, right? So we need to thoroughly go through the agreement to understand the type of arrangement the doctor or practitioner has with the hospital, and then determine our audit steps to reduce the audit risk.
Yes, sir. Sir, kindly clarify the reimbursement from health insurance policies and Arogyashri beneficiary and other allied services from audit point of view.
Okay. So when we talk about insurance companies, so what happens in case of insurance companies is insurance companies operate in a completely different way. So there could be two type of arrangements. First, there could be an arrangement where insurance company ties up with the hospitals. So what usually big hospitals do is, they, since they have a network, they tie up with the insurance companies, and since hospitals are majorly present in majority of the tier 1 cities or tier 2 cities, they give the benefit to the insurance companies, and in return insurance company from those hospitals, right? So in terms of in network, what we discussed at the last of the slide, so those companies are basically in network companies where insurer as well as the patient gets discount. So that could be one way. The other is when the insurance company is not having any tie up with the hospital, that is out of network. So for both the cases, when we talk about the in network companies, we have to see the agreement that is over there between the hospital and the insurer, because the rates are completely different compared to the out of network companies, out of network cases. So for in network, there is a usually predetermined rates that have been agreed between the hospital and the insurer that needs to be referred to while checking the invoices and the collections that are done through the insurance companies. However, in case of out of network or probably the insurers which are not linked directly with the hospitals, the standard codes and the standard rates which usually hospitals to enter person would apply.
Yes, sir. Sir, one question is relating to this medicines for the ICU patients. How to find out an irregularity in prescribing medicines to the ICU patients and they are going back to the pharmacy without using them or giving to the patient?
So again said that, first of all, you cannot identify whether the medicines were medicines referred were relevant or not, because usually as an auditor you are not capable to identify whether that particular medicine would be relevant or not, and they usually give the whole package, the packet of medicine, and not one or two as per the requirement, first of all. Secondly, second topic, where whether the medicines were not used and sent back to the pharmacy, again, all the whenever we talk about inventory, surprise inventory count is the best way to identify such cases. And in case, let's say you do a surprise test where you go to the pharmacy and see that there are a couple of medicine or packets which are of excess quantity, then this gives us straight indication that the medicines from the ICU or probably is coming back from the ICUs or probably the departments, and are not used unless there is a rational, unless there is a process or control in the hospital itself to cover those things. So usually it happens that medicines are taken to ICU, right? In case of emergency, because they just don't run to the pharmacy to get the medicines. They always keep a buffer at the ICU for the patient, and they already bill it to the patient. But in case, let's say, they take it back to the pharmacy, since it is not required, they keep a note. So there is always a check slip which is again sent along with that kind of medicine back to the store, that why this has been sent back. So again, it completely depends upon the control. There might be a stance where there is a control applicable, so you can request those control slips in terms of identifying why these gaps have been identified in the surprise check. In case if those slips are not there, then definitely you need to consider the impact and see how it needs to be reported.
Yes, sir. Sir, how and when revenue should be recognized for TPA receipts? Mean at the time of the claim or on receipt of the mercantile system?
So in case of a TPA, usually revenue is recognized on the date of sale only. It's on point of time, and it's not a period of time. So usually revenue is recognized on the same moment when the services are complete, right? There might be a scenario that the collectability has not been done from the TPA, which I was already talking about, because what happens in case of a TPA is it takes time and they process claims in batches. So there might be a scenario that your that the claim for the hospital gets processed in a month or two or a year or two, right? So it might stand as an AR, but that would not impact the revenue. Revenue needs to be recorded. The only factor that needs to be considered is what one can do is one can check the past trends and see how much provisioning needs to be done or how much impacts needs to be given to AR and revenue basis past trends. For example, let's say
Yes.
previously I recorded 100 rupees as a revenue and 20 was something that was not collected at all, and that I've been observing the same trend from the last 3 years. So I can apply the same thing in the current year as well.
Sir, last question.
Mhm.
Member is asking, can you share some insights or any key frauds experience in times and what precautions the auditor have to check while the auditing the books of accounts of healthcare sector?
So one of a case which I remember is, I mean, usually hospitals have a practice of inflating the invoices in case of ICU patients or in-house patients whenever there is an insurance company involved, just to get more cash from the insurance company. So as an extreme measure, one can go and get a cross confirmation from the patient itself whether these tests were performed or not, to gain comfort.
One more question pop up.
Mhm.
How to deal the referral cost? How to deal with the referral cost when the auditing the healthcare sector, and how to be deal within this audit report?
So when we talk about the referral cost, usually almost all the hospitals tend to adopt malpractice to promote their business or to increase their business. It is usually not found in a cash mode or I mean cash or bank mode, but in a form of consideration which is very difficult to identify. But still, in case if it is identified, materiality concept has to be taken to be considered. If it is really a material amount, then one needs to have a discussion with the management and should be excluded and taken a note of, and see, then we can see how we need to report it in the books of accounts. And if it is not material, then probably it could be let go.
So that means for referral message, referral part, only materiality have to be checked, because one member is in the second part of the question, he is asking where to show in the audit report, how to mention in the audit report while this referral cost. If it is material, then we have to show. If it is means it depends upon materiality.
It completely depends upon materiality. If it is immaterial, then definitely it's not
Any
impacting my books of
disclosure is
accounts.
required. Any disclosure is required in annual report for referral payments. Any
So
sort of disclosure is required.
again, it completely depends upon the materiality. If it is something really material which is impacting my accounts altogether, which might have, I mean, this is something crucial, which might impact the whole financial statements, and then it is required. Otherwise, if it is really immaterial, then it should not go into the audit report, and there is no disclosure required. However, having said that, I need to check probably in terms of whether there is a separate reporting requirements from laws and regulations applicable from government per se, for this, because there is a requirement from Medical Council of India that this is not acceptable. This is not a practice to be followed. This is not allowed.
Okay, sir. So thank you so much, sir. Now we come to an end, and thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India for sparing your valuable time and enlightening all of us various intricacies while the various considerations while audit of the healthcare sector. Thank you so much for your precious time as well as the knowledge sharing. Thank you so much, and I also thanks all the participants of the today's webinar. Thank you so much.
Thank you. Thank you so much.
Thank you, sir.
Recording stopped.